You open your brokerage app and see a fund labeled Sustainable Future. It promises to invest in a better world. Is your money actually making a difference, or is it just paying for an expensive marketing campaign? Welcome to the messy world of ESG investing, where good intentions often collide with clever branding. Let's cut through the noise. First, not all green investments are created equal. Some companies genuinely reduce emissions and treat workers fairly. Others just slap a leaf on their logo. That's greenwashing, and it's everywhere. So how do you tell the difference? Start with transparency. A truly sustainable company doesn't just say, "We care about the planet." It shows you exact carbon emissions, diversity stats and leadership, and third-party audits of supply chains. If you can't find real data, just vague slogans, walk away. Second, look beyond the label. An ESG fund doesn't always exclude fossil fuels. Some large ESG funds still hold oil giants like Exxon or Shell, scoring well on governance, but heating the planet. That's why you must read the holdings. Use free tools like ETF Research Center or Morningstar Sustainability Rating. Ask, what's actually in this portfolio? Third, beware of ESG washing by entire industries. Airlines call themselves sustainable by buying carbon offsets, but many are worthless. Real climate action means reducing emissions at the source, not buying imaginary credits. Here's a rule of thumb. If a company's sustainability report is longer than its financial report, be suspicious. Real change is measured in tons of CO2 reduced, not glossy PDFs. But how do you know a green company is investable? That's where ESG ratings come in, but they're deeply flawed. In Part 2, we'll expose why two top ESG agencies give the same company wildly different scores. Stay with me.
The truth about ESG ratings, successes, failures, and conflicts. Imagine this. One ESG rating agency gives Tesla an A. Another gives it a C. Both claim to measure the same thing: environmental, social, and governance performance. How's that possible?
Because ESG ratings aren't standardized. There's no global rulebook, no single definition of sustainable.
Each agency, MSCI, Sustainalytics, Refinitiv, uses its own secret formula, and that creates chaos. Take ExxonMobil. Some ESG funds include it because it scores well on corporate governance and worker safety. But it's still one of the world's largest oil producers. Is that sustainable? Depends who you ask. Now look at Volkswagen. Before Dieselgate, it had top ESG scores. After it was caught cheating on emissions tests, ratings barely budged for months.
Why? Because ESG models are backward-looking.
They react slowly to scandal. But it's not all bad. There are real success stories. Ørsted, the Danish energy company, transformed from a fossil fuel giant into the world's most sustainable energy firm. Its stock soared 300% in 5 years, not despite sustainability, but because of it. Or Microsoft, which committed to being carbon negative by 2030 and backed it with real contracts for direct air capture tech. Not just promises, purchases. The problem? Conflicts of interest. Many ESG rating firms are paid by the very companies they rate. It's like a restaurant paying Yelp to review it. Would you trust that 5-star rating? And investors are waking up. In 2023, the SEC launched probes into major ESG funds for misleading claims. The EU now requires stricter disclosures under its SFDR rules. Slowly, the fog is lifting. So what should you do? Don't rely on a single ESG score. Instead, build your own checklist.
Does the company have science-based climate targets? Are executives' bonuses tied to ESG goals? Is it reducing emissions year over year, not just offsetting?
Because real impact isn't found in a rating. It's found in actions.
And those actions matter more than ever because climate change isn't just an ethical issue. It's a financial risk.
In Part 3, we'll show how rising seas, wildfires, and regulation are reshaping long-term investing and why sustainable might soon mean survivable.
Let's be clear, you don't have to care about polar bears to care about ESG. Because climate change isn't just an environmental crisis, it's a portfolio crisis. Think about it. A factory in Florida floods. A vineyard in California burns. A coal plant in Germany gets shut down by new regulation. These aren't activist concerns. They're real financial losses, and smart investors are pricing them in now. BlackRock, the world's largest asset manager, now treats climate risk as a core part of its investment analysis. Why? Because physical risk, floods, fires, droughts, can wipe out assets overnight. And transition risk, new laws, carbon taxes, tech disruption, can make entire industries obsolete. Take coal. 10 years ago, it was a safe dividend stock. Today, many coal companies are bankrupt. Not because of protests, but because solar got cheaper and governments acted. That's the new reality. Sustainability equals resilience. Companies with strong ESG practices tend to waste less energy, attract top talent, avoid fines and lawsuits. Over 10 years, MSCI data shows ESG leaders outperformed laggards by 2 to 3% annually with less volatility. But here's the catch. You don't need to go all in on ESG to benefit. Start small. Use thematic ETFs like ICLN or SMOG, or tilt your portfolio toward companies with science-based targets. And never forget, your vote matters more than your wallet. As a shareholder, even with $100, you can support climate resolutions at annual meetings. Platforms like Say or Shareholder Commons make it easy. But the biggest shift? Stop asking, is this investment green? Start asking, is this investment future-proof? Because in 2050, the companies that thrive won't just be profitable. They'll be adaptable, transparent, and low carbon. The rest? They'll be stranded assets, like fax machines in a smartphone era. So yes, your investments can matter. Not because they'll single-handedly save the planet, but because they'll protect your future in a world that's changing faster than ever. If this helped you see ESG in a new light, hit subscribe. We break down money, risk, and the future every week. No jargon, no fluff. Thanks for watching.